I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a riskalyze test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, my name is Steve Jablonski, and I'm the host of Financially Speaking with Jeff Bush. We have a very, very exciting topic that we look at it at the year end of things we can do before the year ends. However, these can be done anytime during the year. With that, Jeff?
Yeah, of course. Well, hello, Steve. Welcome to the show. It's good to be here. I want to acknowledge happy anniversary. It's hard to believe we've been doing this show for 11 years here on the PCTV network. And of course, you can see our show on the local cable PCTV network, or you can watch it on the PCTV website, which is thepctvnetwork.com, or you can watch it on our website, which is informedfamily.com. So with all that being said, Steve, it's an exciting show, 11 years and running, hard to believe. But today we're going to talk about strategies that are always good to talk about, but particularly as we head towards the year end.
Yeah. And when we start off, some people overlook maybe the simplest of strategies, which is gifting.
Yeah, gifting. So with gifting, gifting is a good way to transfer money from your estate to the estate of someone else, typically your children or your grandchildren. Basically, what you can do is you can gift to another person $18,500 per year without any tax consequences. So it really moves from from your side of the ledger to their side of the ledger. And it's really an effective way just to, from an estate planning perspective, it is the most basic thing that you can do, just to gift money. And there's that what they call a gifting amount or a gifting exclusion that you can give every year, $18,500, and that is per person. So if you're husband and wife and you have a child, you can each give them $18,500. So that's whatever that is, $37,000. You can give for a couple, and you can do that every year. Now, Steve, you may want to ask me what happens if you want to give them more than that.
That was my next question.
If you want to give them more than that, you can, because there's a lifetime exclusion that you have in addition to the annual amount that you can give per person. So if you give them more than the $18,500, it simply eats into your lifetime exclusion. So gifting is effective. And it's a good way, like I said, it's a good way to get money out of your estate and into the estate of your loved ones.
Yeah, that's, as I said, it's a really, really basic tool. Now we go into someone that's working and they're employed and they want to save for medical and health expenses.
Yeah. So here we want to talk about the health savings account, the HSA. So with the HSA, Steve, it's generally done through your employer, and the employer allows you to deduct certain amounts into an account that you can use for medically related expenses. So currently that number is $8,550 for a family. And if you're over the age of 55, you could put another $1,000 a year in under the catch-up provision. So that makes $9,550. So why is that a good thing to do? Well, if you have out-of-pocket medical expenses, whether it is your deductible, whether it is a copay,
Yep.
whether it is things that your insurance company does not cover, it could be dental expenses. It's a very wide-ranging amount of things, goods and services that they cover, and you can use this HSA account to do that. So the significance is that you get a tax break, right? So if you're putting money into an HSA, you're putting it in with pre-tax dollars. So if you're putting in $1,000 and you're in a 20% tax bracket, you just saved yourself $200 of taxes, right? So it's a very effective way to do it. We see it in particular with high deductible insurance plans, right? So if you have a very high deductible, this is good money to use for that, to hit your deductible. And the other key element of it, I believe, is the fact that you can carry this over from year to year, right? So if you've got money in there at the end of the year, you can continue to use it, bank it, so to speak, and use it the next year. So that contrasts to another plan called the FSA, which is the Flexible Savings Account. And that one, it's a little ironic that they call it flexible savings because it's not quite as flexible as the health savings account. But that's a story for another show. The flexible savings account is basically a use it or lose it proposition. So you want to make sure that you empty those expenses out, or I should say empty the account out by the end of the year. So if you're watching this show and it's towards the end of the year and you have an FSA account and you got money in it, go out and buy yourself some contact lenses or something that's going to be covered under the plan.
Okay. Yep. Now moving on to saving for retirement and the end of the year or any time during the year, we have the Roths, the 401ks, and the IRAs.
So with a Roth IRA or just an IRA in general, you can make contributions. If you have earned income, you can make a contribution to an IRA or a Roth IRA. If you're married and you don't have income, you can still make a contribution if your spouse works, and you can do that under a spousal IRA. So the limits on that are $7,000 per year, and if you're over the age of 50, you can put another $1,000 a year in, so that's $8,000 a year that you can contribute to an IRA or a Roth IRA. Now with the IRA accounts, you have a little bit of extra time because they allow you to wait until April the 15th to make your contribution. So a lot of people do like a wait and see. They want to do their tax return first, see what their tax situation is, and then make the contribution closer to the filing date of April the 15th. I do want to take a minute, Steve, to talk about the difference between an IRA and a Roth IRA. And that is an IRA, and when I say an IRA, I mean in a traditional sense, a traditional IRA. With a traditional IRA, you're getting your tax break up front. So when you make that contribution to the traditional IRA, you're taking that right off of the top of your taxable income. So if you decide you're going to put $8,000 into a traditional IRA, you're going to reduce your taxable income by $8,000. And then all the money in that IRA account is going to grow tax deferred. So you're not going to pay any taxes on it. So when do you pay the taxes on it?
You take it out.
When you take it out.
When you take
at
it out.
distribution. Yeah, so when you take the money out, you're going to be taxed on the distribution. And if you die with the IRA account, guess what? Your family is going to pay the taxes on the distribution when they inherit it. Now, with a Roth IRA, the taxes work exactly the opposite. So you're not getting any tax break going in when you contribute to a Roth IRA. But in exchange for that, all the money grows tax-free, the distributions are tax-free, and the heirs that inherit the Roth IRA are going to inherit it tax-free.
And that's a good thing. And there are certain limitations on the 401ks annually.
Yeah, so with the 401k, so the 401k is done through your employer, okay? So you can put a lot more money into a 401k than you can into an IRA. You can put, like, I think the number's $22,500 that you can put into a 401k per year.
Yep.
And then if you're over the age of 50, there's a $7,500 per year catch-up provision, which makes it $30,000 that you can put into a 401k. So that's a substantial amount of money that you can contribute to the 401k. And we're big believers of the 401k. That's really how a lot of wealth has been built for for this generation of consumers through the 401k through payroll deduction.
Yep. And with the 401k, there's many times there's a match.
Many times, I would say most times, the employer is going to encourage you to contribute to this 401k by instituting some type of match, whether it might be a dollar for dollar match on a certain percentage. So let's say, for example, they're going to match dollar for dollar for the first 3%, or you may have a plan they're going to match 50%, so up to maybe 6%.
Yep.
So you put in 6 and they put in 3, but regardless, you want to take advantage of that if your employer offers some type of match, because it's almost like free money, right? They're giving you money to contribute to the 401k, and a lot of that is because employers have abandoned the traditional pension. So we no longer have these defined benefit programs, and now they're doing these matches on the 401k as a substitute for that.
And you talked about a Roth or IRA contributions. How about a conversion?
So a conversion from an IRA to a Roth IRA simply means that you're pulling the future tax liability into the present day, right? So if you have a traditional IRA, let's use an example of, let's say you have a $50,000 IRA that you want to convert to a Roth IRA, and let's say that you're in a 20% tax bracket. So if you convert that IRA to a Roth IRA, you have to pay the taxes on that conversion. So now you have $50,000 of taxable income, 20%, that's $10,000. So that's $10,000 of taxes that you're going to have to pay in the year that you convert it. So let's say you convert it this year. So, you might want to ask me, Steve, well, why would you do that? Why would you create extra taxes for yourself? And the answer to that is because you're now, in exchange for paying the taxes, you have now created an account that is going to grow tax-free over your lifetime. And not only that, it's going to grow tax-free over the life of your spouse. So you've got joint life where the money's going to grow tax-free. And then, more importantly, it's going to pass on to your children tax-free. So again, this is a good legacy planning technique in that you're going to be able to do a Roth conversion and pass that money on to your family without incurring any taxes. So a lot of people do that with money that they feel that they're never going to spend, and this is for my legacy, this is for my family. So they do the conversion. Another reason why you might want to consider doing a conversion is because you may have some idle cash that you can use to pay the tax, right? So a lot of times, and especially now, it seems in the last several years, people have built up large cash balances, and rather than just have it sit in the bank and only make a little bit of money, you can really put it to work for you by really paying the tax on that IRA and then move the money into that Roth and get very, very powerful tax-free growth on that account.
Now we move on to something that really is done annually, and we hold stocks or equities, harvesting losses or gains.
Yeah, capital gains, capital losses. So what happens when you sell a stock, the stock is taxed at, if it's held for more than a year, you're taxed at capital gains rates. If you have losses, then those capital losses can be used to offset capital gains. So a lot of times what we'll do at the end of the year, Steve, is we'll sit down with our clients and we'll match those up, right? If we determine that there's, maybe you have a client that's overweighted in one stock, or they're overweighted in stocks in general, and we want to lessen their exposure. Maybe we've done some risk analysis and we've determined that we want to lessen the exposure in the stock market. There may be some stocks that we want to sell, and if you sell them at a capital gain, then you're going to pay taxes. You're going to pay capital gains tax, and then if you have stocks that have lost money, those losses can be used to offset the gains. If you don't have any gains and you only have losses, you can deduct up to $3,000 per year, and you can carry over losses into the next tax year. So let's say, for example, you have capital losses of $15,000 when you go to sell stock. Well, you can take $3,000 a year for the next 5 years to write off that capital loss.
And when you sell a position, what are the rules on, say like you really like the holding, what are the rules on getting back into the same position?
The rules are that you have to wait 30 days to get back in, or else it's considered a wash sale. So you want to make sure you wait the 30 days, because if you don't wait the 30 days, the loss gets disallowed, right? Because then the IRS looks at that as if you were just doing that to reap a tax benefit. Mm-hmm. So they don't like that. So it's a 30-day rule. right? So you just have to wait 30 days to get back in.
And the next subject is required minimum distributions, or what is known as RMDs. And that playing field has changed since the Secure Act. So tell us a little bit about that.
Yeah, so the required minimum distribution, or what we commonly refer to as the RMD, has changed. The first RMD has to be taken at age 73. Not so long ago, before the Secure Act of 2019, the RMD age was 70 and a half. So we had to like recondition everybody to think now age 73 instead of age 70 and a half. So that was generally a good change. I mean, there was some other pieces of that Secure Act legislation that weren't so positive, but the RMD being moved from 70 and a half to age, well, it was first moved to age 72, and then there was another revision to the Secure Act which moved it to age 73. So that's pretty significant, and I think it was in answer to people living longer and people working longer, and really pushing it, kicking the can down the road, so to speak. But the first required minimum distribution is now at age 73, and then you have to take one every year thereafter. And there's a table that we use to calculate the RMD, so you know how much you have to take out. But generally speaking, you have to take out about 4%. It's actually a little bit less than 4% you have to take out that first year.
So it doesn't really matter when your birthday is. If it's January 1st or it's December 30th,
It doesn't matter.
it doesn't matter. Got to be taken out.
It doesn't matter. It used to matter with that half year calculation in there, but now it no longer matters. So if your birthday, for example, so this year, if you turn 73, which means, anytime during the year you turn 73, whether it was January 1st, whether it was December 31st, your RMD is due this year. Now, I got to say this because there's a technicality in the tax code that we have to address, and that is that the IRS will allow you to wait until April 1st of the following year to take your very first one. So if your first RMD is this year, you turn 73, technically you have until April 1st of next year to take that RMD. We generally don't recommend that. Why is that,
Why is it?
Steve?
Why
I'm
is
going to turn the
Turn it over to
questions
me?
on you. Why?
Well, we get that on occasion where a client will come to us and say, I know I can wait, and they may think it's a good idea. However, as Jeff, as you said, every dollar you take out as a distribution is taxable. And so therefore, it's like, say like someone has a $40,000 requirement. If you have, when you're 73, you take 40,000 out, you're only taxed on 40, but if you wait to the year after and take 80, it could put you into a higher tax bracket. Yep.
Yeah, if you take your first RMD, if you wait until April 1st of the following year, you're going to have to take your second one by December 31st of that same year. So in essence, you're doubling up. So which we try to avoid that.
Yep. And how is that, what date did they use to fig calculate your RMD?
They use the balance in the account on December 31st of the prior year. So if you're taking it this year, we look at December 31st balance of last year, and then we're going to divide it by whatever the age factor is.
Yep.
For this year, for your birthday this year, and that's how we're going to do the RMD calculation.
And another question we get often is, Jeff, Steve, I have 5 different IRA accounts. What do we do?
If you have 5 different IRA accounts, you can either satisfy the IRA required minimum distribution in each individual account, or you can aggregate them and just take one RMD out of one account. So So let's say you have 4 accounts that you really like and you don't want to take any money out, and the other one is maybe designed to take distributions out. You can take the money out of just one account. It doesn't matter. I will say this though, if you can set your required minimum distributions up automatically, sometimes that's better because that way you don't miss it. So you have the people holding your money, the custodian, you have them send you your RMD maybe the same time every year. So maybe, and people choose different dates for different reasons, but let's say you do it at the end of the year, maybe you want to use them for Christmas presents or gifts. You can say, all right, on December the 1st, send me my RMD. So then it becomes automatic. And that way you don't miss it. Because if you miss it, the IRS comes down on you pretty hard. Or they put a pretty stiff penalty on missing your RMD.
And still on RMDs, what happens if you're charitably inclined?
Yeah, it's a good question. If you are charitably inclined, there's a provision in the tax code that allows you to send that money, your RMD, directly to a charity, and when you do that, that distribution is not taxable, right? So if you have, let's say you have you used the example of $40,000. So you have $40,000, and let's say you want to send half of that to your church, as an example. So you tell them to send $20,000, make the check out directly to your church, and that way you're not taking constructive receipt of that money. So the $20,000 gets paid to the church, you give it to the church, and that way you don't pay tax on that $20,000, and that $20,000 really is served as a tax deduction.
And the last one we have is estate planning, and not so much doing trust and wills, but maybe just rechecking your beneficiaries.
Yeah, so this is a good one as we close here today. You want to do, we encourage you to do an annual checkup. Just like you go to your doctor every year for a checkup, you want to do a checkup on your will and your estate. You want to make sure the beneficiaries are named properly, because there's a lot of changes that happen in your family, right? Births, deaths, divorces, people moving, et cetera, et cetera. So you want to take a fresh look at that every year, and as part of our practice, we do that as we meet with our clients every year. So there's really a lot to consider, when you're doing your year-end planning.
Yes.
So this is a good show here today, Steve. So with all that being said, we're going to put a wrap on this one, and this is Financially Speaking.